I recall that when this group was first inaugurated about 4 years ago, the first program that we had was also on tax. And so much has happened in the past 4 years, and we consider it rather imperative for us to revisit those issues again. I tell you, you're going to have a very interesting time this morning. We've assembled clearly what is an A-list of tax practitioners, tax experts in the Nigerian industry, the Nigerian economy, and they will be looking at various aspects of tax management and tax efficiency in real estate transactions. I'd like to thank you for joining us and to welcome all of us once again as I hand over to the Deputy President of the Chamber, who will give the welcome address and also introduce all the speakers in some detail. Over to you, Ray Ateli. Thank you very much.
Thank you, Mr. Chairman. I want to welcome all participants at this event on behalf of the President and Chairman of Council, Mrs. Bisi Adeyemi, who is unavoidably unable to make it today, but I am standing in for her. I want to as well acknowledge all those who are participating online. We probably would have one or two of our past presidents, patrons, and other council members. So I welcome you all, distinguished ladies and gentlemen. I am pleased to welcome you to this construction and real estate webinar with the theme, Tax Management for Real Estate Development and Investment, Efficient Tax Management, organized by the Construction and Real Estate Group of our Chamber. Permit me to introduce the Nigerian-British Chamber of Commerce for the benefit of all who are participating, especially first-timers. It is the foremost bilateral chamber of commerce in Nigeria, established in 1977, and our objective is to promote trade and investment between Nigeria and Britain. The NBCC is affiliated to the British Chamber of Commerce, and we are also members of NACIMA, which gives members beneficial access to a network of 53 chambers across the UK and 71 other international affiliates. Membership of the NBCC is currently over 400 top corporate organizations from various sectors of the economy. I'd like to invite anyone who is participating at this event that may not have joined to take full advantage of the opportunity and join the chamber, because there's quite a lot of benefit to be had. The objective of today's event, amongst others already mentioned by the chairman of the group, will include: 1, to discuss the tax liabilities and compliance issues involved in real estate, examine the tax requirements for real estate transactions in Nigeria, explore the developments on land use, charge, laws and regulations, and any other issues that may arise during the course of today's event that are relevant to the theme of tax management for real estate development. This theme is indeed particularly relevant and provides a good opportunity to educate and enlighten our members and real estate stakeholders. It is with great pleasure that I now introduce a formidable team of speakers who will be doing justice to today's webinar. First, and in no particular order, I want to introduce Mr. Ajibola Olomola. Mr. Olomola is a partner and head of the tax deal advisory, mergers and acquisition practice in KPMG Nigeria, and head of the technology, media, and telecommunications group in KPMG Nigeria. He was called to the bar over 32 years ago and subsequently qualified as a chartered accountant as well. He's a fellow of the Association of Chartered Certified Accountants, Institute of Chartered Accountants of Nigeria, the Chartered Institute of Taxation, and other professional tax, legal, and regulatory experience, delivering value to clients across the financial services industry, real estate, oil and gas, and other sectors across Nigeria, Africa, and globally. Prior to KPMG, he practiced law as a seasoned litigator for about 10 years, handling matters before the superior courts across different practice areas. He has also been instrumental to notable policy, fiscal, legal, regulatory reforms in Nigeria. He's not alone in doing this. We also have Ehile Adetola Aimbangbe. Ms. Aimbangbe is an expert on finance, public, and fiscal policy. She started her professional career as well in KPMG Professional Services in 2017, where she was responsible for servicing clients in the consumer, industrial, manufacturing, real estate, technology, media, and telecoms markets. With almost 2 decades of professional experience serving clients, Nigerian corporates, multinationals in various sectors, government, national, subnational, and development agencies. She has acted as tax and business transformation advisor to many local and foreign investors. She has over 19 years of progressive leadership-driven success-filled experience on commercial, financial, tax, and regulatory advisory matters, leading global organizations. She led multiple and large teams across locations with a track record in efficient transactions, concluded by understanding clients' needs and ensuring that advice and solutions are tailored to meet those needs. We also have Dr. Abiodun Ayinde. Dr. Ayinde is a chartered accountant, UK trained information technology auditor, and a graduate from the University of Lagos, where he bagged a BSc degree in personnel management and industrial relations. She equally has a master's degree in business administration and financial management. He also attended the London Guildhall University, United Kingdom, for his MSc degree in computer systems auditing, and the London Metropolitan University with a doctorate degree. He is a fellow and council member of Business Advisory, Business Recovery and Insolvency Practitioners Association of Nigeria, and member of the Institute of Internal Auditors, UK and Ireland. He is the founder and pioneer managing director of Wise Associates Limited, with over 40 diets, professional accounting, lecturing experience. National Rail London UK, London Development Agency UK, ASEGI UK Limited at various managerial positions before commencing a business consultancy outfit, McFord Consulting, a management consultancy firm based in Lagos with branches in London and Chicago. He participated in the issuance of $500 million, 2.25% convertible note that was done between 2007 and 2013, listed on the Euro MTF of Luxembourg Stock Exchange. We equally have Mr. Emmanuel Ibukun Efuntayo. Mr. Efuntayo is a seasoned certified as academic foundation in estate management from the Polytechnic Ibadan in 1982, and later obtained a BSc degree in management and law from Dublin Institute of Technology in Ireland. He has a PhD from Liverpool University and a diploma in advanced property practice and postgraduate diploma in web development design from the Institute of Commerce Management, London. He is also a certified estate agent of the Republic of South Africa. Yes, the team equally has Mr. Tayo Odunsi. Mr. Tayo Odunsi is a chartered surveyor with over 15 years experience practicing real estate in Nigeria. He holds an undergraduate degree in estate management from the University of Lagos, an MSc in real estate finance and investment from Henley Business School, University of Reading, UK, an MBA from Imperial College, London. He is a fellow of the Royal Institution of Chartered Surveyors, a member of the Project Management Institute, the Society of Property Researchers, the Nigerian Economic Summit Group, and the African Real Estate Society. He also serves as a director at Ventures Park, the leading co-working space in the heart of Abuja. Distinguished ladies and gentlemen, I thank you for sitting through this very long introduction, but I can assure you that it was this long because we have assembled a formidable team to do justice to today's topic. And so, once again, on behalf of the President and Chairman of Council, Mrs. Bisi Adeyemi, I welcome you to today's webinar, and I wish you happy deliberations. Thank you. Now, Mr. Odunsi, is for you to take over and anchor the session.
All right. Thank you so much, Deputy President, for that introduction and going through the profiles. Good morning, everyone. Thank you for logging into this webinar. It definitely promises to be a very exciting one. As we can all attest, taxation is very critical for any society and for sustainable development in any country. And as such, every sector has to contribute their own quota to taxation. But when it comes to property and construction, there's a multi-dimensionality to tax. On the transacting side, there are tax matters to attest to, VAT, WAT. On the ownership and occupational side, in Lagos State, we have land use charge, and other parts of the country, we have things like tenement rates. And of course, on the investment side and company side, there are obviously company taxes. And so these multiplicity of tax matters sometimes seem complex for real estate investors, practitioners, and even occupiers to truly dimension. And that's why this topic is very germane in terms of talking about tax efficiency. And to go into this, we have our lead speaker, Mr. Olomola, to kick off. Can I ask Mr. Olomola to start the presentation now? Thank you so much.
Thank you so much, Mr. Odunsi, and with gratefulness to the chamber, this esteemed chamber, for the kind invitation extended to me and my team to speak on this very important topic of the real estate industry in Nigeria, dealing with the tax framework that applies to the sector, and dealing with efficient tax management for real estate development and investment. For those of us at KPMG, we take our association with the Nigeria-British Chamber of Commerce extremely seriously, and I am delighted to be here with you. The chairman of the real estate sector subunit of the chamber is a very dear friend, a senior colleague, a friend of my boss, and a boss to me as well, because in very many respects, he has given us business over the years. He is himself a pioneer in the development of real estate investment frameworks, and I will get to a little bit of that a few slides from now. He has also authored a book on real estate investment, which I recommend to all members of the Institute of the Chamber of Commerce. It will be really useful for you to have that in your library. I'm proud to say that I've got a copy in my library. So this is a very important topic because, like we know, the real estate sector currently contributes 7.5% to Nigeria's GDP. And so that makes it the fifth most important contributor. And like we also know, the performance of the real estate sector also impacts on other subsectors. For example, take the cement subsector. The more investment is put into real estate development, the greater the likelihood that other sectors will also be positively incentivized. Therefore, if the government is really serious about industrialization of the country and growing the economy of the country, it's got to pay serious attention to this sector. And what I'd like to share with you this morning is not only a snapshot of the framework that applies to taxation of real estate business in Nigeria, but to also tell you about what the government has done over the last few years to make transactions in real estate a little seamless. And that would encourage your members to put more money into this asset category. So in terms of an overview, if I move on to my next slide, I will be sharing. Yes, please go on to the next slide. I share an overview of the tax requirements for real estate transactions, specific tax incentives introduced by the Finance Act of 2019, and general comments on real estate investment schemes. In terms of an overview, the moderator, Tayo Odunsi, has done a good job of giving you a snapshot of what's typically the applicable taxes, ranging from companies income tax, which we call CIT, to value-added tax, withholding taxes, capital gains tax, stamp duties, and sundry charges, including consent fees, land use charges, tenement rates. I mean, in this area, in the construction industry, you have all sorts of charges, from local government charges to, I mean, you know what? So many regulators falling over themselves to try and follow the money and get a fair share of the cash flows that they see going into this sector. On the next slide, dealing with that overview, for real estate companies, and this is very important distinction to bear in mind, for real estate companies, real estate assets are inventory. So typically, if I take a bank that owns real estate, say, for example, their headquarters building, for that bank, that asset is not inventory. That asset is a fixed asset. It's an asset that they intend to hold on to for a long time. Therefore, they typically tend to carry it at historical values. I'll come back to this a bit later, but the point to say there is that when you carry your asset at historical value, you're not marking it to market. Therefore, if you take, for example, a head office that was acquired, say, in the 1970s and built maybe a high-rise building built at a cost of, say, 100 million naira in 1970, that property could be worth billions of naira in today's money. If you were to offload that property into the market, maybe billions, but the bank would only be recognizing the value at the historical cost of 100 million. But for a real estate company that transacts in real estate transactions, that buys and sells, or buys, manages, sells real estate is inventory, not fixed assets. And when they sell their real estate, it is treated as revenue. And because it is revenue, it is taxable at corporation income, company's income tax. Compared to a bank or manufacturing company that is holding real estate as fixed asset, when they sell that real estate, it is not revenue, it is a capital transaction. And for capital transactions, it is only the gain that is taxable, and it is also taxable at a lower rate, 10%, which is a CGT rate. And that 10% can still be rolled over if that money is invested into similar or complementary asset class. And the payment of the tax can be deferred until eventual liquidation of the portfolio. So those are very big distinctions to bear in mind between the way real estate companies view real estate and the way regular companies view real estate. I've given you a citation of a case where that was also discussed by the tax courts. Now, so if you then look at capital allowances, what that then means is that the only people that can claim capital allowances on real estate are non-real estate companies. So a general purpose company, a bank, a manufacturing company, and whoever that is buying to hold or owning to hold will be able to enjoy capital allowances on their property. But real estate companies that buy and sell are not able to do that. They can only treat the asset as inventory. Moving on to the next slide, an area where there has been significant challenge in the administration of real estate has been in the VAT area, and there had previously been a lot of aggression and questions over whether properties should be VATable or non-VATable. So initially, the tax authority was minded to exempt land, but then they will say if there's a building on the land, then if you do a transaction in that building, you need to pay VAT on it. That has now been put to rest by the Finance Acts, particularly the one of 2019, which has made it very clear that land and buildings are exempted from VAT. This was also underscored in the Finance Act of 2020. So from 2020, it has become very clear in Nigeria that land and buildings should now be VAT exempt, which also includes when you grant a leasehold interest in land and building. Even if you have, even if the building is a mast, a telecommunications mast, the law has made clear that those category of assets are no longer subject to VAT in Nigeria. That's very good. It allows us to optimize the transactions in this sector and hopefully will encourage an increase in the volume of transactions recorded by the market. Withholding tax is typically an advance payment of income tax. And so typically an outright sale of real estate assets should not attract VAT. Because as I've said, for companies that are holding that real estate as a general purpose company, as a fixed asset, when they dispose of their real estate, it is a capital transaction, not a revenue transaction. Therefore, there should be no withholding tax. But when a real estate company disposes of its real estate inventory, if you follow the logic of the Court of Appeal in the Ibile Holdings case, it would appear that that transaction, being an inventory transaction, is a revenue gain and therefore attracts withholding tax. So it's very important to always ask yourself, in what capacity am I transacting? And you can't really move between the two categories. You are either holding for use, for long-term use, or you are holding to sell. And typically you plan to sell within 12 months. Because for you to qualify as inventory, there must be a plan to sell within a very short period, not long-term. Rent, because rent of real estate assets is typically liable to withholding tax, and that's at the rate of 10%. And you can distinguish between a rent and an outright disposal, which gives you a full value gain. And the Finance Acts have also reduced for construction companies and taking into account the very difficult economic circumstances in which those companies operate and the thin margins, the razor-thin margins that those companies are able to gain in today's market, a reduction in withholding tax rate to 2.5%. And the government should be commended for being able to achieve this. And then on the next slide, I'll talk about CGT and a few other changes that have come up. So as I've said, for real estate companies that are holding real estate as inventory, there is no CGT on sale of those assets. But if you are holding for the long term, there will be CGT on sale of real estate at the difference between the cost to you when you acquire the real estate and the disposal value at the tax rate of 10%. Now, previous to 2019, there was a bit of commingling between CGT and CIT, which made it unclear which framework should apply to what, and whether you should be taxable under CETA for income that you have already paid tax on under the CGT framework. Let me just give you an illustration of that problem. So let's say that you are holding a property as a fixed asset, and you were to dispose of it at, say, 100 million, and you pay your capital gains tax on it. Let's say that the cost to you is 10, and you dispose at 100 million, or let's say 110 to keep the calculation simple. So your gain is 100 million. You pay your CGT on that at 10%. What happens when you put that into your financial statement for the year? Are you likely to pay tax on that income again? Prior to 2019, there was a very big risk that you would, if you are familiar with the whole concept of excess dividend tax and the other anti-avoidance rules that existed in Nigeria. But from 2019, the excess dividend tax rule has been modified, and there has been a ring fencing of income that is taxable under CGT against income that is taxable under corporation tax. And because of that, the historical problems around double taxation on profits earned from real estate transactions has been addressed completely by the tax law. That makes it possible today to do your transaction in an optimal manner and to pay tax no more than once on your real estate transactions. For non-real estate transactions, for non-real estate companies, as I've explained, there's CGT at 10% on chargeable gains. And where that CGT is incurred, it is possible to postpone the payment of the tax by reinvesting the proceeds on gain on disposal into the acquisition of similar real estate. And that's what practitioners describe as a rollover relief. Another matter that has been of very great interest to this sector over the last couple of years has been stamp duty. And this is also an area where I know Adetola is on the line and probably will have a view on this. But this is an area where the lingering controversy has been partly, but not fully resolved. And so you have instances where, if you look at the stamp duties legislation, it publishes certain rates of stamp duty that should be applicable to certain kinds of transactions. For example, conveyances on sale, which will be stampable at 1.5%, leases at a staggered rate, which I've put up on the slide here. If it's less than 1 year, it's 39 kobo. If it's more than 1 year, and so on and so forth, up to a maximum. If the lease is greater than 21 years, or if it's an indefinite term, the stamp duty rate could be up to 6%. And where the consideration is stock or security, 1.5%. Equitable deposits, legal mortgages. But what we then find is that the tax authority has published their own rate of stamp duty, which is different to that which is in the law. And then, to make matters even more complex, when you go to the states, for example, to register your title or to obtain governor's consent, the states also have their own rate of stamp duty, which again is different to that which is stipulated in the law. Now, as a lawyer, obviously, my view would be that the law should prevail. Stamp duty is not a matter where someone can just wake up and say, this is the rate I'm going to use. You got to follow the rate that's in the law. But then sometimes people say, when you're at that point where you want to receive your governor's consent, well, yes, the state government is asking for what's not in the law. Let's just pay it and move on. Maybe we'll challenge it later. And nobody ever challenges it. So hopefully the government will come to the table in future and resolve this whole trouble of stamp duty. I know that the rates in the law are antiquated because they were stipulated several decades ago, even before Nigeria gained independence. However, maybe what we need to do is modernize the law and change the rates in a wholesale manner, as opposed to the arbitrary and ad hoc rates that are currently being used by different regulators. So on the next slide, I point out that state governments and also local governments typically also charge additional fees, for example, consent fees Interestingly, it's not all states that charge the consent fee. In many states, the consent fee is just an administration fee. It's not a percentage of the land value. In Lagos State, for example, the consent fee has been moderated into a percentage of the state value ascribed to the property. So the state will do a valuation, and they have their own valuation rates that they apply, and then they will charge you a percentage. It used to be 8%, it used to be 15%, then it was reduced to 8%, and I understand that there's some discussion about further modification of those rates, but I know the Ambode government did publish a revision, but then the current government made some modifications to that. That's still ongoing. Tenement rates may apply, which are typically paid by the occupier. And of course, in states like Lagos State, there are the land use charges that have got to be paid. In the interest of time, I'll move on very quickly to other changes that have been introduced by the Finance Act of 2019 and 2020, because I know this is an area where Chief Oguniran is also particularly interested. The very first thing is that a framework for the operationalization of real estate investment companies has now been provided. So where hitherto, if you were to set up a real estate investment company, and I know that Akim struggled with this when he was setting up UPDC as a real estate investment trust. One of the key questions they had to decide was, should we be a trust? Should we be a company? What framework applies to us? If you do a company, it won't be a pass-through. You pay corporation tax, you pay withholding tax on dividends. I mean, by the time you cascade the tax on the cash flow coming from investors into the real estate, flowing back towards the investors, the tax was multiple. When we did a model of it, you would essentially pay up to, it was about 65% as tax on profits. So obviously that was the project was dead on arrival as far as real estate investment companies were concerned. And so the only framework that was open to investors was that of a real estate investment trust. I mean, I don't have the time to go into the technical difference between a real estate investment company and a real estate investment trust. But let's just suffice to say that without a legislative framework in place to optimize REITs, real estate investment companies, a REITco would not be a pass-through, while a real estate investment trust could potentially be a pass-through, potentially, depending on who the trustees are. That was a limiting factor to the growth of this sector. If you think about economies that are more developed than Nigeria, think of South Africa, the UK, the US, real estate investment trusts are used generally across the world to pull resources together to finance infrastructure. Think of airports, think of public buildings, think of roads, think of hotels, think of large housing projects across the world. Many of these are held by real estate investment trusts, which also allows the public to participate in the financing of such transactions and the growth and industrialization of the countries where these entities operate. So it was a bit sad that Nigeria didn't have a framework that allowed REITcos to operate. The Securities and Exchange Commission had rules, but those rules were inchoate because the tax rules were holding everybody back. In 2019, the Finance Act amended the legal framework to optimize real estate investment companies, providing clarity to exempt rental and dividend income received by REITcos from tax. What that means is that if you set up a REITco today to hold property, and you've got to comply with very exacting standards that have been published by the Securities and Exchange Commission. So you've got to first of all be a REITco authorized by SEC. You will then be able to pull finance from investors, invest in a real estate class, either directly or through SPVs that are holding those real estates, and the income that's swept up from your investments is optimized by exempting it from taxation, which means that the discussion I had earlier about the tax you pay on rentals, all those things, you're exempted. There'll be no more withholding tax on your rents. There'll be no more tax if you were to exit the portfolio, and no more CGT. No tax at the operating level. No tax at the corporate level. And it achieved a perfect pass-through where the tax will now be in the hands of the ultimate investor. And that tax will only occur once instead of occurring 3 times through the cycle. That was a landmark tax change. And I'm not sure that the industry has quite come to terms with the fact that this asset category has now become optimized. What I would expect to see is over the next few years, there should be a funneling, there should be an increase in the asset classification and asset category, and it should now be much easier for real estate developers to aggregate funding for specialized projects. It should also be possible for manufacturing companies that are holding real estate portfolio at historically repressed values. Think again to the companies that I described, who may be holding assets that they had purchased some 20, 25 years ago and reflecting that on their balance sheet at, say, 100 million naira. And yet they need funding for their operations, and they are going to banks to go and be borrowing money. But they are sitting on real estate that can be valued in today's money at billions of naira. With this categorization that is now possible, it is possible to put all that into a class and create a REIT around those assets, provide liquidity to the company, and provide also access to the public to participate in the wealth of those companies. So I expect to see a growth in this sector, and I will throw a challenge to the members of this Chamber of Commerce who are specialized in the real estate business to begin to take a look at what you can do to optimize your respective portfolios by investing in REITCos. REITCos were not the only things optimized by Finance Act. I've already described the exemption of land and building from VAT. I've also discussed the fact that withholding tax was reduced for companies in the construction industry. And it also eliminates several instances of multiple taxation that are recorded in real estate transactions. So what does this mean for investors? The value proposition for REITs, as I've described, is completely optimized in Nigeria today. And where Mr. Oginiran had to spend, he will probably speak about his own experience, but I think putting that REIT together for the UPDC REIT must have taken Mr. Oginiran and his team over a year of extremely hard work. I think you'll find that the life cycle for sponsoring those projects should be much shorter now that the framework for treating such entities as pass-through entities has been simplified. And already we're speaking to a number of investors who are putting funds together for REITs, which was not happening before. And so we expect to see more happening in this area. This will be an opportunity for those who then go to the capital markets to also improve the performance of our capital market and provide more opportunities for retail investors to also participate in the wealth of the corporate Nigeria. On the next few slides, I want to talk about REITs in a little bit more detail. Obviously, as you can imagine, I'm very interested in REITs because we at KPMG are tenants, are the anchor tenants to the UPDC REIT in terms of their project in Victoria Island. So we are not only advisors, we are also live participants in REIT schemes. And I would like to give you a few more details around how REITs operates. I believe I still have about 5-10 minutes more, I believe. Tayo?
Yes, you do, sir. Yes, you do. Please go ahead.
Thank you very much. So without taking too much of your time, I'll probably not read through everything because I've also highlighted some of that in the course of my presentation. A REIT, a real estate investment scheme, REITs is a collective investment scheme that's set up under the Investment and Securities Act and the rules and regulations published by SEC. If you recall, I did say that there are some exacting conditions that SEC typically stipulates for you to be licensed to be a REIT. One of that is that they don't like to see commingling. So they want you to ensure that at least 90% of the revenue, excluding capital gains, that will accrue to the entity should come from rental or dividend income that's generated from real estate. That's to make sure that specialization is brought to bear and you don't have companies that are doing general production or general merchandise, also masquerading as REITs. So your REIT has got to be a special purpose vehicle. It's got to have a focus on that asset category. It cannot be an all-purpose company. It also has to have several governance organs because, again, you're raising money from the public, and so you need to have some comfort and structure around your governance structure. And so you need to have an investment committee in place, which will have competent people who understand investment and cash flows and can look at an investment and tell you whether it makes sense or not. You need to have a fund manager. You need to have a trustee that will be holding the real estate title. And the UPDC Trust, again by Akim, actually pioneered the use of a trust component as a means of passing title, where rather than have title transferred and incur significant consent fees, you can have the holder of that title declare themselves to be trustee to the benefits of the REITs for the title to the property. That again reduces costs and brings innovation to the title structure for a REIT scheme. Also, you need to have a custodian in place, and typically you'll also have an issuing house, especially if you're going to be issuing securities to the public. I've already described REITs as either real estate investment trusts or as real estate investment companies. The main difficulty with real estate investment trusts, which operate in many countries, is that in Nigeria, the structure is considered to be opaque. So by the time you are speaking to your financiers, you find that they don't understand exactly how trusts work as an investment vehicle. They can understand trusts as in the terms of a custodian, someone holding title, but the conduct of business by means of a trust is something that banks don't fully understand. So banks will typically prefer to finance a real estate investment company in comparison to a real estate investment trust. In terms of the regulations that have been introduced by SEC and the government for the real estate investment schemes, it all starts from 1999 with the ISA. In 2007, that was amended, and the first SEC regulations dealing with real estate investment trusts were issued. These were amended in 2017. In 2019 and 2020, the Finance Act was issued by the government, and the FRS issued complementary information circulars to explain to the tax-paying public exactly how they would apply these rules to real estate investment companies. And the FRS must be commended because they have taken an extremely positive view of this asset category, and they have worked assiduously since about 2017. They started looking at this, and by 2019, they had made recommendations which were borne out by the Finance Act for the optimization of this sector. That in itself shows the way the private sector must go in pushing for change to our regulatory environment. We have regulators like the FRS that are very open. They are receptive to comments from the public. They are reactive, and they are always willing to champion the cause. If we can show them a reasonable business case, they are willing to champion the cause of the private sector in pushing for positive change. And this is an area where I spare no words to compliment the FRS for the very good work they have done in this area. And on the next slide, I then take the cash flows. Move on to the next one, please. In terms of the tax efficiencies. So by Finance Act 2019 and 2020, REIT profits are not taxable under CIT Act. However, to qualify, the real estate investment company must distribute 75% of its profits within 12 months. So you can't just not pay the tax, sit on the money, investors are not getting the money, taxman is not getting any money. So these tax incentives are being given on condition that you must distribute. And it is not a strange requirement. In almost every country that I have personally looked at, there are similar stipulations. In some countries, the requirement is to distribute 80%. I've seen a country that requires distribution of 90%. But in Nigeria, the requirement is to distribute at least 75% of your dividends rental income within 12 months. Now, as I said, SEC expects this company to be a uni-focused company. But you know, the taxman is not going to work based on assumption. So as far as the taxman is concerned, if that company does any other business and earns any other income, they will pay tax on such income at the usual rate that other companies pay tax at. So the special dispensation is only with respect to income streams from real estate investment business. When those dividends are then paid to unit holders or shareholders, as the case may be, they are also exempted from withholding tax. But if there's dividend from non-REITs income, that will be subject to withholding tax. As I've said before, Finance Act has clarified that real estate assets are not VATable assets. So that's complementary. CGT should be applicable where assets are disposed by the REITco, and stamp duties may apply, for example, on incorporation and at disposal of real estates. I will now discuss unit trust schemes. The reason I would like to talk about unit trust schemes is because the current law on unit trusts has not yet been fully amended to reflect the tax efficiency, the same tax efficiency that we see for real estate investment trusts. And without going into the details of this, it suffices to say that even though you can create your real estate investment scheme as a unit trust scheme, also licensed by the Securities and Exchange Commission, because of a potential double tax that is unintended in the Companies Income Tax Act, I believe that the FRS is looking very closely at this, and I believe that they are making recommendations that will address it in future, maybe in the very short term. So I probably won't elaborate too much on those problems because in a sense, the problems are going to go away very soon. But I still think that because of those distinctions, we should clarify that real estate should be distinguished from unit trust schemes, you know, because for real estate investment category, the main income category is from dividends from landholding SPVs or rental income. But unit trust schemes generally tend to invest in wider asset classes. They tend to invest in securities, equities. They tend to invest in the bond market and debt issues. And so their cash flows are more disaggregated. And so they earn, if you like, the yield on your treasury bills will be, for example, akin to interest income, and you'll suffer withholding tax and or corporation tax. So the commingling of income at the unit trust scheme is one that doesn't lend it to the best use as a real estate investment scheme. But with the passage of the Finance Act, we shouldn't need to come to unit trust schemes when setting up our real estate investment schemes. We can now use the REITco framework to achieve that purpose. And also for bear trusts, I try to draw a distinction as to why people may consider, like UPDC, considered using a bear trust. On the next slide. Should move to the next slide. On the next slide, I talk about how some people might consider using the bear trust. No, that's the preceding one. You need to go to the next one. Next slide, please. Okay, my slides are not moving, but you still get the slides anyway. It's my last slide. Next one. Thank you very much. So some companies like UPDC have experimented with the use of REITs as bare trusts. And in itself, the idea is that you should work as a pass-through scheme. As I've said, most investors are a little bit uncertain about how this works. And I know that even the sponsors of that scheme did a lot of work to give comfort to investors and to clarify the corporate structures through which ultimately the bare trust was made to work. So with that said, I thank you so much for your attention. And I'll be happy to take a few questions after other speakers have had a chance to speak. Thank you very much.
Fantastic presentation, Mr. Olomola. Thank you so much. You indeed have done a very great work of going through the real estate value chain from a tax perspective, and we can see that it's very elaborate and it's a very complex subject that requires a lot of skill in handling, and that's why we are indeed very grateful that you've taken us through this. I'm sure there are going to be a couple questions, so please do feel free to hang on. I'm going to have the panelists give some presentations as well, and then we'll go into a Q&A. But I have a few questions, for you. Rollover tax relief, of course, is very exciting, and I would like to understand some practical applications on that, and also if some of these real estate investment schemes can also enjoy some rollover tax relief on potential exits within their portfolio. So those are some things that we'll be talking about. But I'm just going to quickly go and have the panelists, have presentations. Like I said, when looking at the entire value chain, which Mr. Olomola has obviously touched on, but we want to go a little further into conversations about tax compliance for real estate companies, which Ms. Eile will take. Dr. Ayinde would then go ahead and talk about VAT and withholding tax implications, while Mr. Futayo would then round up with conversations on land use charge, essentially taking us deeper. So if Ms. Eile Adetola Aibangbe is ready, can you please take us on tax compliance for real estate businesses? Thank you so much.
Thank you very much. Good morning, everyone. I'd like to start by saying a big thank you to Mr. Buniro for the invite. I'm so delighted to be here. And thank you so much, Ajibola, for making my work very easy. It's really easy going after you. It just means that I don't have to do much. And I also see Wale on the call as well. Good morning, Wale. It's nice to see you. Wale is a mentor and a boss of mine. Good morning. My work is pretty simple this morning. I've been asked to talk about, the various compliance touch points for real estate players, and also how do you then deal with tax liabilities before and after they may crystallize. I had a few slides, but I think we will just walk through them because Ajibola has covered most of the things on the slides as well. In terms of compliance, can I have the next slide? Is that what you need to sort of have an overview of how the taxes are grouped. In Nigeria, our taxes are grouped in three parts. So depending on how big or how robust your operations may be, you may find out that not only do you have to remain compliant with the federal taxes, you may have to deal with all local governments as well in Nigeria. So just depending on how big your operation is. I won't be able to talk about tax compliance without sort of shedding light on the business structure. Listening to Ajibola as well, I realized that a lot of us may be at different value chain within the real estate sector, and it's very important that whatever place you play within the value chain, you do have the right business structure that meets your needs and requirements for that moment. There are two predominant value structures, business structures in Nigeria. You have those that are limited or incorporated by the CAC, like we like to call them, whether it's the limited companies, the companies limited by shares, or the limited partnership, which was one of the new concepts that was introduced by the recently amended CAMA. Then we then have partnerships, enterprises, and sole proprietorship, tend to be less statutory obligatory and also in terms of when you then look at the tax structure within these two business structures. For those incorporated by the CAC, you have two layers of profit of taxation, okay, or profit taxation. The first layer is at the company level, which Ibola told us. So if you're into trading in real estate, so if you are a real estate company, your company level taxation will be about 32%. Okay, then you then layer that again with, because at the end of the day, you then need to become stewards of your shareholders. You then layer an additional 10% that you need to pay out, to the shareholders, which bring your total tax burden to about 42% if you're incorporated, by CAC. But if you're then maybe a group of partners like we are, or maybe you're individuals, or you're an enterprise, then you have just a single layer of taxation, and that is at the owner level. Okay, so that's a single layer of taxation model where the effective tax rate is currently about 20%. Talks through. Can you go over, because I can't seem to move my slides? Can you move on the slides? I've done this. Sort of talks through the various obligations. I have an appendix where you can see that. Then Jibola had sort of walked us through the taxes, CIT, VAT. So I wouldn't label you on those facts as well. I mean, with respect to stamp duty, I quite share his views as well on stamp duty. I'm actually in slide 7, I think. I share his view on stamp duty as well. I think there's an overhaul of our stamp duty laws is currently needed and needed quite fast as well. So we're expecting that will go into the works immediately. Some of the bigger things are done, and then work will commence on that. But one of the things that the Finance Act has done for us, like Jibola rightly mentioned, is that land and landed transactions are now VAT exempt. So what does that mean for a real estate company? It means two things. Even though you don't, I'm on slide 7, Tayo. Even though you currently may not pay, if you're into real estate, you may not pay VAT. You then become an agent of government, particularly if you're doing 25 million and above. And what do I mean by that you become an agent of government? Slide 7, this is slide 7, yes. What do I mean that you become an agent of government? The government will require you to help deduct or self-account for VAT from people whose transactions are below 25 million. So if you're working doing business, transactions are below 25 million, we didn't charge you VAT because they are also enjoying some form of VAT exemption. The onus is now on you to self-account for those VAT and hand that over to the government. Same thing if you're doing foreign vendors or non-resident companies that you're working with, you have obligations in that regard. So you may not have output VAT in the sense of it, but you have VAT deducted as source or VAT or VAT self-accounted for that you then need to account for. Okay. In terms of the flip side, I'm giving that the federal government has taken a position and has also aligned with the Land Use Act that land should reside with the states, and therefore VAT should no longer apply. Stamp duties would now apply. So I'm aware, that a lot of the states have started geotagging so that they can start to effectively implement stamp duties in their locale. But as Jibola rightly said, it's amazing how it's so simple and have multiple rates within different states. So it's hopefully that as we review the stamp duty law, it will become uniform no matter the states you go to. But right now, it's not uniform. He also talked about withholding tax and CGT, which I wouldn't dwell on because Jibola had dwelled on that a lot. But we then have other compliance taxes, which other compliance requirements, whether you're talking about your employee compensation levy, you're an employer of labor, what you have to deal with in terms of industrial training fund, pensions, your employer contribution for pensions, business premises levy, which also differs from state to state, development levy, which also differs from state to state. These are all other compliance requirements that real estate companies or real estate businesses have to deal with on their day-to-day transaction. Some tax planning ideas that you may like. And one thing I would say talking about tax planning is that one, it has to be very proactive. You can't start tax planning planning after the event has occurred. Like Jibola was giving us Mr. Kim's situation. They put it into the plan before, so it has to, and the objective is that it must be legitimate and it must be legal. And one thing about in tax planning is actually using the appropriate legal structure or the appropriate business structure to meet your tax objective, which is so amazing that you can use, to give you an excellent tax planning opportunity, an excellent tax planning idea that the government has really signed up to say, I want to encourage real estate investments in country. Another one, perhaps as well, maybe you're not as big as the UPDC of this world to do REITs. You may also consider what kind of business structure you want to adopt. Maybe you want to sell a land. How do I sell the land in the most efficient way? Do I sell the land or do I sell the company? Do I sell the company warehousing the land? So those are some of the ways you can think about and play around with, in ensuring that you're using the right tax framework in getting value. Other thing I'll talk about is tax incentives. I'll talk about that in the next slide. There are also some tax incentives that are available specific to real estate companies and also general as well. Tax efficient models as well. So you must look at what kind of tax efficient model do you want to use. If you want to situate a holding company in a DTT friendly zone or in a tax efficient location, to say to yourself, how do I want to better leverage technology, particularly when it comes to digitalized assets? How do you want to better leverage that in ensuring that you're not too exposed, to tax as you will be? In terms of incentive, there are two sector-specific incentives. Jibola talked about REITs extensively, so I wouldn't pause on that again. The second one is pioneer status. This has been there for a long time. It's basically a holiday window that gives you about 3 to 5 years tax break, when you're into real estate, when you're into certain transactions in real estate. Some of the transactions have been listed above. One of the things that NFPC have said to us over time is that one thing that they think is also lacking, that they want to support investment in, is warehousing. So perhaps you're thinking about, okay, maybe you're trying to say, where should I think about, as you invest and all that? May I ask that maybe you look into warehousing as well, because they've actually said to us that they don't have enough warehouse as we should, and also, so that's something you may want to look into. Health and supporting structures like specialized hospitals, laboratory centers, medical cities. Those are some of the things they're also encouraging. They're also encouraging holiday resorts, that they want to see a lot of theme parks, a lot of resorts, low and medium income housing estates, particularly in very de-emphasized areas where there are not a lot of investments. In addition to the tax holiday, there are also a lot of benefits that comes, with Pioneer. Other incentives that are not as specific to real estate, but real estate firms can also enjoy, is full and partial exemption from interest on foreign loans, particularly for those that are doing big time transactions and you need to go get foreign loans to do those kind of things. One of the key things you can sell to your investor is that they may get full and partial exemptions, if they do put in some foreign loans into the investments. Road infrastructure development and refurbishment tax credit scheme. That is also something that is very, very, the country is very keen on that. So you may have clients that want to take advantage of that. Rural investment allowance, there's certain rural investment allowance that are given. I spoke about those that may be interested in building low income estates, in rural areas. The good investment allowances that you can get as well from that regard. I would then say, in terms of common pitfalls I have seen and why people get in trouble, one of them is just lack of internal control system. Oftentimes than none, you don't have the appropriate internal control system, whether it's poor or it doesn't exist, from a tax compliance perspective. So what I would say here, start early, start on time. And if you haven't done that, try and then regularize your records. What I've also seen that is a common pitfall to people is inappropriate investment. I gave an example earlier on, maybe you want to sell a piece of land, like I was saying about, you own this land for years and you haven't done anything in it, but the book value is much more smaller than it currently looks. some people, some tax planning idea may be, okay, you sell the investment vehicle instead, which is the company, and then you then sell that off. What that gives you is, one, there is no CGT on the sale of that shares because there is no CGT on that transaction. Multiple taxation is also something I have seen that has been a common pitfall, particularly as you go from state to state. Failure to pay, charge, deduct, and file returns, and this piles up as well. You know, in terms of when failure to do that. My practical tips will be: one, identify where you want to play in the value chain, whether it's your investment size, whether it's the risk profile of the players of the return. Just make sure you know where you want to be within the value chain. Review your product mix on a day as you go by, and know, okay, do I want to do REITs, or do I want to just stick in my buying and selling, or do I want to just stick in my leasing? What part of it do I want to work in? And I'll say manage your resources and systems very, very well, particularly as it relates to your accounting systems, your people, your talent. Make sure they're well. Make sure you manage them critically, and make sure they don't create new tax budgets for you. As much as possible, seek advice. If you can outsource your compliance function, it makes life easy for you, and then you can focus on your core business. Three, I would say, seek education, so you also know when your tax consultant is not telling you the right thing. So seek education, be proactive, join communities and trade associations that help you fight your cause. Thank you very much, and I look forward to the question and answer segment.
All right. Thank you so much, Haile. That was very, very insightful. And I can just imagine if we had a little more time, how much more depth you'll have gone into, obviously closing very well with those practical tips, which when we have some question and answer, definitely I'll be taking you up on some of those practical tips, especially looking at what you even opened with, talking about the different incorporations, all right, that create different types of tax efficiencies depending on the value chain of any particular player. So those are some conversations that we'll be having as we get into the panel session. But at this point, I just want to call on Dr. Abiodun Ayinde to just within the next 7 to 10 minutes to just talk us through VAT and WAT efficiency. Thank you, Dr. Abiodun.
Thank you, Tayo. I'm grateful. NBBC, thank you very much. My task is just to put you through some explanation regarding value-added tax, arithmetic, and withholding tax process. Previous speakers have touched on almost all the relevant issues, and I just want to go through specifically what we need to do to be able to be tax compliant with regards to VAT and withholding tax. Remember, tax efficiency, it's clearly knowing about the tax, manage your tax, and process your tax relationship and interaction with your business. To the extent that not only are you meant to calculate those taxes correctly, you are meant to be able to file at the right time. Now, going straight to the slide, value-added tax, simply consumption tax. I don't want to go into which state collects and so on and so forth. Value-added tax, the consumption tax, and you'll be exposed to it because all of us are agents of government ensuring we pay it, we collect it. Now, that's where the gray area is. Remember, it's governed by law. It's borne by final consumption, and it's for goods and services. Goods and services on the line. Now, all goods and services produced within or imported into Nigeria are taxable, except those specifically exempted by VAT law. So when you purchase goods and services, local imported, you have to pay VAT. Now, there are 3 types of VAT, and these are the beginning of course, this slide explains where some people get it confused. Now, there's a standard rated VAT supplies. Those are the goods and services that are meant to be VAT at 7.5. Then you have the exempted supply. Those are the goods that you don't VAT because it's exempted. Then we have the zero VAT supply, meaning these are goods and services that is zero rated. Of course, that doesn't mean it's not VATable, but because it's zero rated, it's not going to be VAT for now. And they are basically non-export items, goods and services, diplomatic goods and services, and those goods that are humanitarian and donor related or donor funded project. So you need to first know which of the goods and services, and that is what will determine the basis of your calculation. Now, the next slide, please. So we have VAT is chargeable on goods and services. So this slide is just to clarify those goods and those services. And if you have those goods, you will see everything is include property, tangible and intangible, such as articles of trade, rights, goods, and property. Of course, we're going to clarify that, like previous speakers have mentioned, real estate particularly have some benefits regarding, because property have various sides, the transaction side and the investment side. So the ones that have been exempted are clearly enumerated in the Finance Bill 1920. But these are chargeable VAT goods and services. You need to be able to understand that when you offer those goods, when you buy or purchase those goods and when you offer those services, VAT will be affected. Next slide, please. Now, the taxable person, taxable person are required to register within 6 months of commencement of business, file VAT monthly returns, not later than the first day of the following month of transaction. That is an implication of tax administration compliance. Then these three group of tax payers are obliged to deduct VAT source and remit to tax authority appropriately. This just to ensure tax is effectively collected. They are the Nigerian company that are carrying on table transaction with non-resident companies within the country, government ministries, statutory bodies, and other agency of government, then companies operating in oil and gas sector. These are people that are meant to deduct tax, value-added tax, Then we have list of goods that's exempted, and this is the area I want you to take note. If these goods are exempt, if your services are exempted and your goods are exempted, you just need to charge tax. But of course, all medical, pharmaceutical products, basic food items, books and educational material, baby foods, agricultural fertilizer, all export, plants and machinery. And the last one is land and building, of course. There are cases that clarify that land and building are not goods or service. So that has been rested, and Finance Bill also assists with resting that. Then you have services around medical service, those rendered by Community and People's Bank, and Mortgage Bank. Then you have all other services that are related to export. Then we have tax appeal tribunal clarifying that rental income derived from lease and real estate property, whether for residential and commercial purposes, beyond scope of value-added tax. Just to clarify that if it's not goods or service, it is not VATable. Next slide, please. Then we have value-added accounting. This is the area that gets naughty. I've come across loads of clients who deduct tax wrong, value-added tax wrongly, they compute it wrongly, and they even remit wrongly. So we need to clarify that the accounting requires you to have 3 records: your purchase record, your sales record, and your VAT account. As you purchase, you have VAT input recorded. As you sell, you have your VAT output recorded. And your VAT account should be able to now say the input and the output, the balance will be remitted. Next slide, please. So for example, if you are purchasing if you are purchasing, that means you have to calculate your VAT input. Of course, I use this simple illustration because most transactions that exclude VAT, it's so simple, straightforward to deal with. To the extent that you will see that calculation will be straightforward. But when you include VAT, that is when you see there are issues. Now, suppose you buy 35,000 worth of items, that is what 35,000 worth of items. Then what you do is make sure the purchase itself is debited with the 100%. And 100% in this case, because it's including VAT, that means the item is 107.5. So you make sure the purchase is 100, which is a net, and the simple arithmetic is 100 divided 107.5, which will give you the 32.558.1. Then the VAT itself is going to be 7.5. Divided by 107.5 will give you the 2,441.8. And the amount will now be a credit to the payable or the supplier. The focus here is note that your purchase is net. The VAT input is the 7.5, and the addition of the 2 is your total purchases. Next slide, please. Then we now have the sales side. As you purchase, you're going to sell. When you sell, the transaction, I use the same company example here, that if you sell an item for 50,000, inclusive VAT 7.5, the debit will be 50,000, and the sales will be the 100% of the 107.5. Then you credit 46,501.6. Then the accrual will be the 7.5 divided by 107.5, which will be 3,4887. So you have VAT input from purchases, and you have VAT output from your sales. Now, the next thing is, what do you do with the two VAT? You have to remit the balance, because we are allowed to deduct the input from our output before remitting. And this is the area that people get confused. So a simple VAT account will help you with that. Next slide, please. So we're going to have VAT output 3,488. The VAT input will be deducted from that. So the VAT you're going to remit is 1,046.51. Remember, there's a standard form I've included in the FRS site where you can download the form. It has the output to be filling, the input to be filling, and the balance will just be the subtraction of input from the output to be remitted. Now, these are the simple calculation and arithmetic that helps with tidying up our VAT and ensure. So the next thing is the withholding tax. Of course, the withholding tax issue is about so that tax evasion can be eliminated. Well, is withhold some tax, then at the end of the year, make sure you use your withholding tax credit to adjust your tax liability. Well, what I've noticed in this area is the fact that those that are withholding, either they don't process or through the FRS correctly, or the state's internal revenue board to get the credit out. And most people, when they have withheld their tax, they didn't even bother to process with their tax liability adjustment. So what I've laid out here is what withholding tax is, just an advance payment of income tax. Whether individual or company, you are paying advance as you transact, so that when you now get your tax liability, you can use that position to deduct. Now, the person must file within 21 days. The penalty for failure to deduct is 10% of the amount. Then the company is required to submit an electronic form. That's the new FRS position. Withholding tax is the method used to collect income tax in advance. Withholding tax is deducted at varying rates depending on the type of transaction, at the vary between 5 to 10% individual and companies. Then the due date for filing withholding returns 21st days every succeeding month. Penalty for not filing, it's obviously what we have mentioned. Then there is a place you can download equally the withholding tax form, what we use in filing or remitting the withholding tax that is supposed to. Next slide, please. Then you need to know that withholding tax deduction cover the following transactions: all aspects of building, construction, related services, all types of contract, agency agreement, consultancy, technical professional services, management services, commission, interest and royalties. Then the basic for reduction of withholding tax is definitely to address the problem of tax evasion. So, well, if you're going to pay 10 million and 6 million have been withheld while you are transacting, then it means you're going to pay 4,000. The only thing is the relationship between what is withheld and what you meant to pay need to be addressed and really processed to facilitate. Now, the next slide is about the item, areas where we have value added. Now, there are 8 areas where I've pointed to. We have the dividend and interest and rent. For companies, 10% withholding tax, and individual is 10%. Director fee, that's individual. Hire of equipment, 10 and 10. Royalty, commission, consultancy, technical and service fee, 10% and 5% for individual. Management fees, 10% for companies, 5% for individual. Construction, road, bridges, 2.5% for companies and 5% for individual. Contract other than sales is 5% and 5%. So basically, it's so much of knowing those rates to be able to facilitate correct computation, correct calculations, and appropriate remittance. Thank you very much for listening. I hope to get back when we get to question and answering section. Thank you.
Thank you so much, Doctor, for that very, very insightful presentation. I must say that is the simplest and clearest explanation of VAT computation that I've ever seen. And I'm sure it's very insightful to a lot of our attendees who perhaps have been overpaying VAT and not doing their computations very well, taking out the inputs from the outputs. Thank you so much, sir. And our final panelist is now going to take us on land use charge, obviously from a Lagos State perspective, Mr. Emmanuel Ibukun Efuntayo. You're welcome, sir.
Thank you very much, Tayo. And let me appreciate the Nigerian-British Chamber of Commerce for putting this program together. I've actually learned so much, even from the previous speakers, and I'm grateful to them. Quickly, we're going to look at land use charge. We're using Lagos as a case study because it will appear all other states, when they are doing their legislative measure related to land use charge, they tend to copy Lagos. So it's better to use Lagos. So when I'm speaking to Lagos, talking about Lagos, it's some of these things also applicable in other states. And I'm going to look at issues like the persons liable to pay charge, value of land use charge, relief rates, exemption from payment of land use charge, demand notices, assessment appeals tribunal, penalties, defaults in payment. And I'm coming from the background of a practitioner. I was involved in the preparation of the property register in Lagos State. Then Osun State now we actually do end-to-end. We do the property registration. We do the property register, the tax roll, billing, and also collection. So we've seen it all. And I want to begin by saying land use charge is just a land-based tax payable on real properties within a tax jurisdiction. It's actually local government that's supposed to be collecting land use charge. But in most laws, you see that the state government will say the local government can outsource that one to the state, by agreement with the commissioner for finance or whoever is the designated commissioner. So you see, it's actually the state that is collecting, exercising that right. That of Lagos State, some states, because I was in Imo has got it. Some states, I was in Nasarawa, some states do not have the land use charge bill. They're still operating the old method. We have the CGT, tenement, and all those things. But Lagos is actually the first one that has done this. And therefore, that of the 2018 law, there was 2020, but later on, maybe because of public outcry, the state has to go back to using most of the provisions in 2018 Act. And it replaces and includes all the property and land-based rates and charges under the land rate law, the neighborhood improvement charge law, and tenement rates, which means immediately the land use charge was promulgated, law was promulgated, the tenement rate law, the neighborhood improvement, multiplicity of taxes, this law has been able to resolve that. And the tax liability relates to land and improvement on it, which is wherever, just like in law, they say whatever is attached to the land is part of the land. Everything attached to the land could be fixed, it could be movable. They are considered for land use charge. I remember in Osun, they've never collected a charge on gold mines and all these mining licenses. We were able to bring them in. So the next one, who are the person liable to pay? You are the owner of property, the owner of the property, the occupier holding a lease of 10 years and above. There's also another provision in the law which says the occupiers of leases 10 years and below. I just believe it's a matter of redundancy. So let's say, apart from the owner, also occupier. In terms of the calculation, is about to have the market value times the relief rates and annual charge. Market value, we have that we are supposed to do the valuation of land, which is the assessors, essence of and value are the assessors. Valuation of the land plus the development on the land. It could be building, it could be any other, it could be a mast, it could be anything on the land. Then you multiply that figure with relief rates. The law has actually provided some reliefs. We have a general relief, which is about 40% applicable to everyone. We have some that are specific reliefs, like if you're a pensioner, you won't pay anything. A person with disability, you are giving 10% relief. Aged person, 10% relief. So many other ones, so partial relief. There were partial relief on land use charge too for non-profit making NGOs. That's the relief rates. So I think let's go to the next slide so that I don't take your time. But also the onus is on the person seeking relief to actually apply for it. It's not given to you automatically. The assessors may not have given it to you. So we need to look at these reliefs. You can download a copy of the law. There's a schedule attached to the law where you see all this relief, so that you look at it, whether you have been overcharged or, so if it's something you need to look at, you are the one that will apply for your relief. For example, if you're a pensioner, nobody will know you're a pensioner until you bring documents showing you're actually a pensioner. You are aged, you've been living in the place for 25 years or more, your age is 60 or 70, you are the one that will apply to government. You may not be given as at the time of the assessment. The exemptions from the land use charge. We have a property owner and occupy religious body used exclusively as a place of worship or religious education is exempted. But if you are using that one, for example, sometimes some churches you have, or most you have bookshops and all those things, all those are not exempted. Where you sell tapes, they are not exempted. Public cemetery and burial grounds, they're exempted, which means like Ikoyi vaults or the one in Lekki. If it's a private cemetery, it's not exempted. Property used as a registered educational institution certified by the commissioner to be non-profit making, you'll be exempted. Public library or certified private library will be exempted. Palaces of recognized obas and chiefs, it's just palaces where it's not the other property owned by the recognized oba and chiefs will not be exempted. Property occupied or owned by NGOs may also enjoy partial relief. That's just about the exemption. The issue of demand notice, it may be delivered to an owner, occupier, authorized agents. That's the problem we have now. Most time, the one we are doing, you go to places, who is the owner of this property? Nobody wants to volunteer. So the law has actually conceptualized that. So what we do is you give it to, maybe if you say managing agent in there, or you can identify a tenant. That is then in the eyes of the law, is also an agent of the state. They can collect, maybe the money is supposed to pay to the landlord. Part of it, you can use it to settle the land use charge. And at the end of the day, do a kind of a set-off. It can be posted on the property where we cannot identify the owners. I remember in my own estate now, because they couldn't know the name of the owner, you just say to the property owner, that's what they will do that. And they can paste it there, just take a photograph, it is sufficient. Also, payment is expected within 30 days after the delivery of the man notice. And I would say we should take advantage of that. If you pay within 15 days, you're entitled to about 15%, discount, which you can apply for. So let's go to the next slide. Sometimes you are dissatisfied with the amount given to you to pay. You can appeal to the tribunal. Actually, the headquarters is in Jupiter way in Alausa there. You can apply, but before you can apply, you must have paid 20% of the land use charge. And the grounds of appeal will be when the assessed property is not chargeable, or you are not supposed to be charged, but they charge you, or you are not liable, and but they still charge you. For example, if you are a church now, what you are using for a place of worship, and you are sent a demand note, you can always appeal to the assessment appeal tribunal. Let's go to the next slide. In the next slide is penalties. We have penalties, appeal tribunal penalties. Refusal or neglect to cooperate with the property identification officers is an offense. Because you see the identification officers, mostly who are estate surveyors and valuers, they go in there to take data attributes of the property. They want to know when it was built. They want to know, is it 3 bedroom, is it 4 bedroom? Those are the things that will help us prepare the asset register and also prepare the tax roll. If for any reason you refuse to cooperate with them, that will be an offense. One further offenses too, incitement of another person to refuse to pay land use charge is an offense. You incite or assist any person to misrepresent in any way. You are not giving us the right information. It's also an offense. The assessor that information, and the offense is punishable 250,000 a fine or even imprisonment for a period of 3 months. In terms of defaults, also government is imposing penalties. If you default between 45 and 75, you didn't pay your the service charge between 45 and 75 calendar days, it used to be 25%. I think it's now 10%. I checked it up last night. I saw it's 10%. Default between 25 and 105 calendar days, it used to be 50%, it's now 20%. Default between 105 and 35 calendar days, used to be 100%, it's now 50%. After the 135 days, the enforcement action can commence. Before you need to be given 3 notifications, but now it's used to 2 enforcement action. A government can sue, government can levy your property. Your property can even be put up for sale. In some other clients like South Africa, they will sell your property and give you change at the end of the day. So just I would say my advice: number 1, take advantage of early payments. There's discounts ascribable to early payment, so that you get that 15%. Number 2, take exemption of the reliefs. Take advantage of the exemptions and reliefs, which, like I said, you need to be aware of. Avoid the penalties by not delay in payment. If you delay in payment, your property can be sold. Your property can be levied, or even your government can take you to court. If aggrieved, pay 20% of your bill and appeal. Also engage professional tax advisors like estate surveyors and valuers who are trained, who are provided for in the law to advise you before you pay. Just an advice will save you a lot of money. Thank you very much. I'll be ready to take questions at the end of the day. Thank you very much for this opportunity.
Thank you so much, Mr. Efutayo. Thank you for really taking us through land use charge. I'm sure it's very, very clear right now. Can I please invite all the panelists and, of course, Mr. Olomola also to just put on their camera now, because essentially we're just going straight into the panel session Q&A. I'm going to be able to ask at least one question to every panelist and potentially be able to do a second round. We have very limited time, but can I please ask the attendees that if there's any question that you want to be answered, can you use the Q&A tab? And one of the panelists, especially if you even identify which of the panelists you'd like to answer the question, they'll be able to answer those questions online, and that way we're able to cover more ground over and above what we might be able to say on this webinar because of our limited time. I'm going to essentially start with Mr. Olomola, and of course I gave you a hint to some places that my mind was going to as you were speaking. Thank you so much for clarifying the tax paradigms for real estate companies and of course for non-real estate companies, and also obviously showing that because real estate companies, they are real estate essentially inventory, they are not liable to CGT, while the non-real estate companies have it, as it's a capital transaction when they trade in real estate. But one thing they can enjoy is rollover tax relief. I know there are a lot of investors, that have exited one real estate transaction and gone into another real estate transaction, but have gone ahead to pay CGT when they could have enjoyed that relief. Can you just shed more light on how this works, in practice?
Thank you very much, Tosin, and thank you for this program that's so well put together. I've enjoyed listening to all the speakers, and thanks to all of them for the very valuable input they have provided to all of us. In responding to your specific question, I would try to avoid giving an overly technical answer. I'll try and keep it simple. So the objective of rollover relief is to encourage business people to keep their capital in play. So if you have a property and you dispose of that property, realizing a capital gain, typically government will tax you at 10%. You can defer the payment of that tax by taking the gains you've made and putting it into a similar property. And the law allows you to bring forward a property that you acquired either 12 months before or up to 12 months after the date on which the gain arose, and then put that property forward as qualifying for the rollover relief. In other words, I am due to pay tax of, say, 100 million to government today because I sold my property and I made a capital gain. Rather than pay that 100 million, I will take the entire disposal value, which includes the 100 million, and put that into another property. And because I am recycling the money in the economy, I'm keeping the economy going, probably increasing employment, increasing other economic activities that the government measures in one way or another. Government then says, okay, I will hold on, since you yourself have deferred collecting the money in your pockets. You have deferred putting it into your pocket for a while. Government too says, I will defer collecting my tax until you eventually cash out. So that's the simplest way I can explain rollover relief. It's a bit technical and it doesn't apply to every asset. There are very limited categories, but land and buildings are a category that would qualify. So that's the simplest way I can explain rollover relief to non-technical tax people. Thank you very much.
Brilliant. Thank you so much, sir. And I also wanted to ask, just as a follow-on, can REITs also take advantage of this rollover relief?
Absolutely. In fact, that is what I expect would happen. So I'm UPDC. I've built a 13-story property. Investors have put money into that. At a certain point of maturity, I dispose of that property. Now, the investors in this scheme are only interested in routine return on investment until the point of eventual divestiture. So there's no pressure on the sponsor of the scheme to return that capital to the owners. The owners want to see their capital being worked. They want to be seeing return on investment annually. That's what they want. So when you dispose of that property, when they eventually do, rather than give the money back to investors and unbundle the scheme, they can just put it into another property and then into another property. and then into another property. And you can imagine how much more accretion to the economy we can achieve if funds are simply deploying capital over and over into rollover property, rollover property, rollover property. I think it will create a very exciting place for the country where infrastructure can actually be developed, also in the way that Adetola spoke to earlier. So yes, real estate investment companies can benefit from rollover relief when they eventually dispose of their portfolio. Thank you very much.
Brilliant. Thank you so much, Mr. Olomola. Eile, when you are speaking, you struck a nerve when you were talking about, different incorporation structures and, tax efficiencies, that it depends on the kind of business that you're doing to determine the kind of tax efficiency. And why I say struck a nerve is, I suffered that. I had a certain incorporation structure that was not suitable for the kind of business I was. So I was, essentially overcharged until I got some advice. Hey, I want you to take, I love the way Dr. Ayinde simplified the VAT calculation. Can you just take a case study, right, of Tayo & Co., who is a real estate services company? Can you just talk about what kind of incorporation structure and the tax efficiencies he may enjoy as against Northcote Limited, which may be a real estate development company? All right, it's a development company, but Tayo is just Tayo & Co. There's really no & Co there. It's just really Tayo. So what kind of incorporation structures would you suggest, and what are the tax efficiencies that these two different structures can enjoy? Eile, you're muted if you're speaking. Okay.
Yes. Thank you very much, Tayo, and thanks to the other presenters. That's very insightful. I particularly like the one on land use charge. I know my rights now. So I would say one thing. Like you rightly pointed out, it depends on where you are, what you're doing, and what kind of value chain you play. So if I take your example, so we have Tayo Limited, right? Who has incorporated. I remember I mentioned that for limited liability companies or limited partnerships, you have two layers of taxation. So at the company level and at the owner level. So let's say this is Tayo Limited and this is Tayo & Co. on the left and on my right. They both make 100 million in profits in year 2020. What would happen to Tayo Limited is that Tayo Limited will go ahead and pay 30% of CIT, which is 30 million, okay? An additional 2% of his accessible profit. So that means if he's doing above 100 million, okay? So an additional 2%, that's when he will pay 30%. 30% only comes in when he's above the threshold I mentioned earlier on. Okay, so once he goes above that threshold, he then does 30%. So let's assume it's 30 million, it's his profit. So his revenue is definitely above the threshold. So he then does 9 million, okay? Then he does another 2 million, 2% on that 30. That gives him another, for the sake of argument, 2 million. So that's a total of 11 million, okay, as his tax liability. He then takes away 11 million from 30 million. He gets 19 million. Hope my math is correct. Now I need my calculator. Apologies. So he does
19 is correct.
So he does 9 million, okay? So and then he does another 2%. Okay, that's 6 plus 9, so he does 9.6, right? So he then takes away that from the 30 million, he gets to 20.4, which is his profit that he wants to declare to himself for doing a great job, him and his wife, for doing a great job that year. Okay, so he declares this 20 million to him and maybe his son or his wife that owns the business together. He then suffers another 10%, okay? That brings him to another 2 million. So in total, he had 9.6 plus 2.4. So that gives him a total of about 11 million in taxes he will pay as Tayo Limited. Flip it if he's just Tayo, right? And his taxes are due to his state government. So he just takes that his 30 million and he does an average of about 20%, which is 6 million. So two people, similar businesses, and one is paying half of that. So that's what you get from not knowing the right tax structure to use at the stage of.
Sorry, Aileen.
Yes.
Aileen, you muffled out a bit. Can you just say what the final tax liability is on the two structures? We didn't quite hear that.
Oh, I'm so sorry. The limited will give you 11 million, right? I think, yes. Sorry, 12 million, which is 9.6 plus 2.4. So 12 million. And then oh my God. Okay, something is wrong with me today. Oh.
You're muted, Aileen. You're muted.
I'm so sorry. Okay, where did you stop hearing me?
Okay, can you just come again with the final tax liability on both structures?
Oh, I'm so sorry. The limited will give you 12 million on one side, right? And then the other structure will give you half of that, which is about 6 million. That's what I said. Did you get me now?
Okay, beautiful. Yes, but obviously there are other efficiencies that he enjoys if he's on the limited in some cases. So,
and that's what I wanted. That's what I wanted to go by. So you also know that tax is not the only consideration, right? So be very, very careful. But that's why I said you need to understand where you are in the value chain and what you want to do. Definitely, you can't do that with a REIT framework. So the things you can't do with certain types of business structure, but know where you are and how you want to play. Thank you.
Okay. Thank you so much for highlighting, and sorry about network issues. Dr. Inde, obviously, I enjoyed you speaking about VAT, and I think you didn't quite have enough time to get through WAT. And the question I want to ask, I'm sure there's lots of people that have this issue. So you send your client an invoice, right? And you've put in all your VAT and all of that. Next thing you find out is they send you less money than you were expecting, right? And essentially they're saying they're not going to be responsible for certain taxes, which according to the law, and I'm sure Mr. Olomola will back me up here, they should be liable for some of those taxes. You're a service provider or you're a developer, you're trying to sell that property or whatever, and you're just left with what recourse do you have? What can you do? Do you take the money and walk? What would be your advice as a tax consultant in that scenario?
Simply, thank you again, and thanks everyone. You see, dealing with clients is a different pot of fish. I just need to know that they need to be managed. Education, relationship review, and all that. You can't do anything than to educate them and let them understand where you all stand with respect to tax compliance and liabilities. If I, of course, most of my clients, like you said, is a very good example. They always want to, but as soon as I educate them, I let them realize these are the consequences, particularly if you do not comply, you don't comply, they come around you with audit and all that, is twice what you have, penalty, interest. And so if you really can go through the education method and make sure your clients understand what he's saving from doing what is right, that's the whole game. So no other choice. The moment the law says that's what we have to do, until the law is changed, we have to do that. And that's a good thing about it.
Absolutely, I agree. And I most likely will be engaging you to break these things down for some of my biggest clients.
All right. No problem.
Yeah, Mr. Futayo, thank you so much for educating us on land use charge. But when we come with regards to land use charge, in practice, and you would know, the issue oftentimes is sometimes there's overcharging, and then a lot of things you've touched on, negotiating, paying on time to enjoy those discounts. They are very, very helpful, and it was good to learn. But sometimes the challenge is who is responsible, all right? And what we have sometimes is, you know, representing landlords. Sometimes they want us to insert in a document that the tenant will be responsible for the entire land use charge. Now, as professionals, we both know that the land use charge is a merger of both occupational tax and annual ownership tax, right? So there is a component that essentially is occupational, that the tenant or whoever is the resident is responsible for, and there's a component that, you know, the owner is responsible for. So is there some illegality to this, and how do you manage this sort of conflicts?
Well, thank you very much. In the eyes of the law, the primary party that is liable is actually the landlord. But also the law says that sometimes it may be difficult to identify who is the landlord, and that's why the issue of occupiers also come in. So if you cannot get the landlord, if like they say, if I miss the ball, I don't want to miss the leg. So if I can't get the landlord, then I will use the occupier as an agent, just like in withholding tax, that we are agents, you know, collecting. So the same thing, the occupier will know who his landlord is. And the occupier can even pay out of the rent he's supposed to pay the land use charge and give it to, and collect it from the owner. But everything also depends on in terms of lease agreements that they've reached. Some where it depends on who is the weaker party now. Some landlords, you know, they will try and shift that responsibility to the tenant or the occupier. So, but primarily it's the landlord. I mean, the landlord is to pay, but if not, the occupier. And when you talk of occupier, it does not matter whether you're occupying the place legally or illegally. An occupier is also, from the eyes of the law, is distinguished from a lodger, who is somebody staying in an hotel, a licensee. But an occupier, you have been there maybe 1 year, 6 months, and there's a relationship. Whether you are there illegally or legally, you are in the eyes of the law, you're also the owner, when the owner is not around. Or even the agent, the managing agent also is under a duty, the legal duty, to ensure that government collecting. You know, it's very difficult sometimes to get some of this information. And I know now with data collections everywhere now, we also know who the owner is. Primarily, it's actually the owner that is under, usually before, you know, under the tenement something before, sometimes the occupier that is, but in the land use charge, under the land use charge law, is actually the owner, or we can also have the occupier, you know, to pay. So even there was even a press release one time by the commissioner, because people were asking, why is it that occupiers are paying? No, the commissioner also came out with a press release that it is the owner that's supposed to pay. The owner, but if you as a tenant now, you waive off that something and you choose to go into an arrangement with your landlord, then it's your problem. That's why I see sometimes some landlord, when they argue, they say net of all taxes. Never agree to that. They say net of all taxes because it's a way of actually dodging their own responsibility. Thank you.
Okay. Thank you so much, sir. This has been a very, very exciting session, but unfortunately our time is fast spent, but I'm sure we've learned a lot, and, you know, we'll probably be able to get access to the video and presentations, and then we can educate ourselves better. I think there's even still some time for you to type in your questions, and, you know, the panelists will quickly try and take a stab at responding to them. But this has been very exciting. Thank you so much to all the panelists. I've learned a lot, and it's been enjoyable moderating this session. I'm just going to hand over now to the Vice Chairman of the Construction and Real Estate Group, Mr. Yemi Ejidiran.
Thank you very much, Tolu. My job is to express our vote of thanks and make some few announcements at the end of this session. On behalf of the Chamber, I would like to thank the speakers and as well as the moderator for these excellent presentations and question and answer session. I also like to thank the patrons and council members, our sponsors, Royal West African Ceramics, Eximia Realty and Wema Board Limited. Ladies and gentlemen, the Construction and Real Estate Group, and the Nigerian-British Chamber of Commerce headquarters for this webinar. We have some upcoming events. Number one is the Nigerian-British Chamber of Commerce members induction and technical sector launch themed Minding the Gap, Fem Techies, holding on Thursday, November 18 at 6 p.m. at the British Deputy High Commissioner's residence. Number two event is the Nigerian-British Golf Tournament holding on November 25 at Ikoyi Golf Club. Tee-off is 6 a.m. The third event is a highlight event for the year, the Presidential Inauguration Dinner on Friday, December 3. We invite everyone to attend. If you are interested in becoming a member of the Chamber, please visit our website, www.nbcc.org.ng. Finally, please follow us on social media to be informed of all our activities. Thank you very much and God bless.